When Indian stock market are hitting record highs, Chinese stocks are witnessing a meltdown. February 2021, this was the last month when Chinese stocks hit their most peak. Post that, it has only been a bloodbath in the stock market. They have lost over $6 trillion since 2021, which is in 3 years. The amount, $6 trillion, is equivalent to nearly twice Britain's annual economic output. But what's leading to the meltdown? Let's analyze. Hello and welcome, I'm Pallavi Sharma and you are watching Money Wise with ET Now. Hang Seng Index has crashed 30% so far this year alone. Shanghai Composite and Shenzhen Component are also down 11% and 26%. These losses highlight a crisis of confidence among investors, and they are concerned about the country's future. This is also a reminiscent of 2015-16 market crash. Since 1990s, the Chinese stock market has been performing really well, but the bubble peaked in June 2015. Chinese stocks lost over 30% of their values within just 3 weeks, and the slump continued in early 2016. The government at that time cut interest rates and devalued their currency. Margin conditions were also relaxed, transaction costs were lowered, but all of this failed and trading was halted temporarily. They even enforced a lock-up period that effectively prevented large shareholders from selling holdings for 6 months. Post this, circuit breakers were installed and on the same day, short selling was banned. The market had corrected as the economy started to cool off. This time too, the country is facing a pyramid of problems, including a downturn in real estate, deflation, debt, falling birth rate, shrinking workforce, and a shift in policies that rattled private sector and scared away foreign firms. Chinese economy grew 5.2% in 2023. This was the lowest pace of expansion since 1990, excluding the 3 pandemic years. So China may be staring at decades of stagflation to come as per analysts, and this is impacting negatively on investor confidence. Over the past year, the country has rolled out only piecemeal policies to drive economic recovery, but experts say that that is not enough. Goldman Sachs has said that they should go for more aggressive, big bang approach to overturn the negative narrative in the market. On top of that, the US-China relations forced investors, especially the US investors, to reduce their exposures to Chinese equities. While chairing a cabinet meeting earlier this week, Premier Li vowed to take action to boost the market. A report said that Chinese authorities are considering intervening more directly by mobilizing some $282 billion as a part of stock market stabilization fund using offshore accounts of Chinese state-owned companies. As per the report, the fund will buy Chinese listed shares through the Hong Kong Stock Exchange. So far this year, Chinese market is among the worst performers in the world. This comes at a time when the global stock markets are rallying, led by Wall Street and Japan in Asia. India has also surpassed Hong Kong earlier this week to become the 4th largest equity market in the world. And one of the main reasons for India's record rally is China's slowdown. The China Plus One supply chain situation has been one of the biggest beneficiaries for India. Due to the lack of investor confidence in China, international funds are allocating more funds to India instead of China. Even some of the biggest firms like Apple are now slowly shifting away from China and manufacturing in India. While Nifty is up around 20% in the last 1 year, Hang Seng is down 30% in the same period. Economists expect that China's growth will slow down even further and drop below 4% in the medium term, while for FY24, analysts say that India may grow at 7.3%. So well, this definitely seems to be India's decade as of now. And for more such news and views, keep watching ET Now.
If you like this video, then like, share and subscribe to ET Now.